you have a practice or are you running a business? Valuation is the ultimate KPI.
Hey there, it's Mike Langford. Welcome to another episode of the Modern Financial Advisor Podcast, brought to you by Truelytics, the one and only comprehensive advisor transition management platform, and also now the world's most complete provider of RIA benchmarking solutions. That's right. If you head on over to riabase.com, what you're going to see is something that frankly is probably going to change the world for the RIA business segment, because Truelytics has gone to the SEC database and pulled in every single SEC registered RIA firm's data, all the public data, into this solution and benchmarked it, right? So if you want to see how your firm compares to others across a whole host of metrics that are pulled from that SEC database, go check that out. But more importantly, Truelytics has also pulled in the data from the thousands of RIAs that are in the Truelytics database that have entered their information in there and have gone through True Performance. So what you're going to see is an incredibly in-depth analysis of your business. So if you have an RIA firm that has $200 million AUM, you're going to see how you stack up against other firms that have around $200 million in AUM and so forth. So it's really, really interesting stuff and very actionable for your business. So do check that out. If you are an owner of an RIA firm, whether you're a solo RIA or at a larger one, go there. If you work for an RIA firm, go there. And if you happen to just be interested in RIAs and kind of curious about what the heck I'm talking about, riabase.com. Get on it, okay? Check that out. So today on the show, we have Jason Gallagher of ViewPointe Strategies Group, and affectionately within the Truelytics community, Jason is known as OS Jason because his business focuses on helping OSJs, those Office of Supervisory Jurisdiction for independent broker-dealer firms. These are typically individuals who own a business and they have lots of other independent financial advisors who kind of give them a share of their revenue for certain support elements that are offered through that person. They're taking the burden of some of the compliance, complexities, and so forth off their shoulders and so forth. And it works out really well. And Jason will explain it in a lot of detail. And by the way, if you're an OSJ or you're at an independent broker-dealer, you already kind of know what an OSJ is, but really, really cool stuff, talking about trends, what Jason sees for the future, some of the solutions, some of the things that OSJs are currently struggling with, and how he sees the opportunity for them to improve their business and so forth. So we cover a lot of ground. Also joining OS Jason and myself is Terry Mullen, the CEO of Truelytics, and Terry has a lot of great insights from that space as well. So really great conversation. We go for a long time and we get a little wacky near the end there. So, hey, if you got an hour or so, hang out with us. We're going to be just shooting the breeze on OSJs and really, really cool stuff. So you got to like it. Okay. As always, make sure you do like and subscribe to the podcast. It's on Apple Podcasts, Spotify, Stitcher, SoundCloud, wherever you like to get your podcast jam on. And you know what I always ask you? Send in your questions and suggestions for the show. You can reach us at podcast@truelytics.com, or you can hit me up. I'm at Mike Langford everywhere. I am loving the new flow of suggested guests that I'm getting a lot. I'm starting to get more and more of those all the time. So really good stuff. Keep that coming. But make sure they're relevant for this show, right? The audience is RIAs, individual financial advisors, executives at wealth management firms like independent broker-dealers and asset managers, right? That's the people that are listening to the show. So don't send me somebody who's got a cool dog walker app. It's really not appropriate for this show, okay? All right. Without further ado, let's get to it with Jason Gallagher, a.k.a. OS Jason, and Terry Mullen. Here we go. Well, Terry, Jason, great to have you guys on the podcast. I'm really excited about this topic of the OSJ market or space, however you want to refer to it, because we've been talking a lot about it offline. And looking back through all the episodes we've done here, we really haven't spent much time talking about OSJ. So looking forward to getting into it with you guys. So welcome to the show for the first time, Jason.
Hey, thanks, Mike. Thanks for having me.
Yeah, that's great. And welcome back as always, Terry. I feel like, we're like almost co-hosts now. We're like on all the time. This is great.
Yeah, thank you. Love being back.
So I thought a fun thing, or maybe not fun, but a good way to kick this off would be to talk about some of the biggest challenges facing the OSJs as we look at it now, because we're in a tumultuous time right now. Obviously, hopefully a once in a lifetime time, but more broadly, like even before the pandemic, and looking out a little further, I think there's probably some challenges in the space, and every business and every business person is going to face some challenges. So, one of the biggest challenges that's highlighted by Truelytics a few different times is the lack of ownership by advisors, by OSJs of the advisors' books that are in their organization. So I thought that might be a kind of a quick way to kick that off. Jason, when you talk to OSJs, do you see that as something that they're concerned with?
Yeah, Mike, it's a great question, and it is starting to come up more and more throughout the body of work that I do within ViewPointe Strategies Group. I've been working with large OSJs for a multitude of years, 14 years, and predominantly spending the past 7 years really focused on this aggregation, large enterprise, large OSJ space. And typically in the history of these businesses, they are very much, as I like to say in the rental income business, working with advisors in their practices, their firms, supporting them from a compliance standpoint, from an RA standpoint, down to local services, helping advisors lower their cost to serve their clients, middle office, back office. It is a traditional business model where now firms are starting to think about it a little bit differently as they look at enterprise value and look at the value of ownership over rental income, the rental income business. It's definitely become a bigger topic of conversation. And ultimately, it's how do you step into that marketplace and go down that path of potential ownership. But absolutely, it's a big topic of conversation these days.
Jason, this is Terry. Can you just expand? Because I really love the analogy that you use of rental income. Just expand on that and give kind of a sense on how that equates and the difference and how they can turn that into, owning income.
Hey Terry, it's a great point to expand on. The rental income model that I'm referencing is the typical OSJ type of model where the OSJ, the enterprise business, is charging an override or a platform fee, whatever you may call it, to process business within their platform. So it could be attributable to compliance, it could be attributable to the RA's standpoint. But I come from an independent world. Independence is really big with all of my clients and prospects that I work with. It's about autonomy. It's about the advisors owning their particular practices underneath it. Typically, the enterprise doesn't have any ownership or control of those businesses, which is fine. And that's the model that it's been for many, many years. And it will continue to be for many years to come. But what they're doing is they're charging a platform fee. And Terry, or Mike, if you were part of my enterprise and tomorrow you woke up and said, hey, I don't want to be part of your RA or OSJ anymore, in most cases, those advisors and those firms have the ability to leave. So I always like to refer it as rental income business because your tenant at any point in time can pick up and leave and look for services elsewhere. Typically most with 30-day notice. But that's what I mean by that rental income business. So there's really no true ownership of those assets. First, Mike, if you owned a book of business, you truly own that revenue, you own that client relationship, which is a complete difference in valuation when you look at enterprise value, Terry, from the ownership standpoint versus the rental income standpoint. So that's a little background on my thought around the rental income business.
Yeah, that is a really big challenge when you think about it, as if you have a stream of revenue in which you rely on, but you have virtually no control over, and you have no ownership over, right? Like if any of your advisors that are within your OSJ decide to leave, or if all of them decide to leave for whatever, some sort of revolt or something, that income just goes poof and you have no real recourse to keep it, right? And so yeah, that's a huge challenge. You mentioned, rental being the parallel. Every year the lease comes up, if the tenant decides to renew or not, renew, right? You have no ability to tell them you have to stay. So it's very possible that, you know, that business could disappear. Now, it's probably unlikely, but it's definitely something where I would imagine OSJs occasionally think hard about it.
Well, and it's interesting, and I don't want to take this analogy too far, but if you think about the wirehouses, right, where or an employee model, where the the advisor will always say they own their client, the relationship, right? Their clients are their clients. And if they decide to move to another wirehouse or somewhere, they're going to do everything they can to bring those clients. And most times they will. However, technically, in almost every case, and there are exceptions obviously to every rule, but those clients are owned by that mothership and they'll assign those accounts to another advisor. And there's a war of who can grab those assets. But you still, they can assign somebody else, they basically own that office and they put somebody else in to take those accounts. Where in the independent world, it's a lot easier for someone to unplug out of one OSJ and plug into, or one broker dealer and plug into another and bring those clients en masse to them. And all of a sudden, poof, goes that rental income, as opposed to, maybe that it was in the former example, the revenue might go down a little bit because there's not as much transaction or stuff as the new advisor that's assigned to that book gets up and going, but they still have the majority or control of those assets.
And Mike, another point to that, it really it's boiling down to the diversification of revenue within the enterprise of the OSJ model. And we're in this phase, and we've seen this over the past few years, past probably 5 years, of margin compression happening at that business level, where it becomes a battle of higher payouts. One firm offering 92, the other firm offering 93, so on and so forth. That trend is happening. So really, where I see the challenge with these larger firms and the aggregators is the diversification of revenue
Mhm.
of their business, and that's really one of my main focuses, is helping them understand that, identify areas of opportunity like the ownership of revenue versus the consistency of, or the non-consistency of, rental income revenue.
That's a good segue, Jason, into kind of like the other two challenges, which I actually think represent opportunity, right? You mentioned diversification of income, and happy to hear your thoughts on that in terms of the different types of revenues that an OSJ may be able to put into their business and make sure that they aren't relying solely on that commission override. One of the challenges we talked about, and we've talked about it a bit here on this podcast before, is lack of transparency of the OSJ down into the businesses in terms of health and performance for their advisors. Because look, again, those advisors are independent, as you mentioned. So they're really, they're only obligated to, provide very little bit of information to the OSJ, but having transparency down into that business can actually not only make the OSJ feel better, I would imagine, but also give them opportunity to help improve the business of their advisors and therefore make their advisors more sticky, I would imagine.
Absolutely, Mike. The transparency piece is huge, and again, I spent multiple years in this space, and OSJ slash enterprises having the transparency into the book of business is very little, looking at the masses from their relationship standpoint. I've been working and known Terry for a long time, and when we started going down the path of really diving into Truelytics, the light bulb went off for me. And in conversations with Terry, was really the power of that actual tool. The valuation piece is great. It's very important, especially in times like this, for business owners to truly understand the value of their business, what drives value. But then you look at the enterprise side of it, and you look down into the transparency. So when we talk about transparency, what is transparency? It's the P&L. It's where the money's being spent. It's the technology that is being used at a local level. And in many cases, the enterprise isn't dictating what tech stack to use. A lot of that, sometimes that's dictated by the broker dealer and or the custodian on where they're plugging into and some of the capability aspects there. But for the most part, what I've seen and what I continue to see is there is no transparency down into that tech stack, that local level P&L, how much is actually being spent on staff to run the office, rental costs, things of that nature. That is definitely not in scope at the enterprise level. And what's great about the Truelytics platform, when you have advisors adopt it and start utilizing it and see the value in it, that becomes very transparent, and it really helps the enterprise. When I talk to firms that I work with, it's really understanding what's driving the business at the local level, the cost. What is the after tax, or excuse me, the pre tax revenue of that firm look like? And what's really important for that local level business is the cost to serve their clients. I've seen businesses run at 20% net profitability, and I've seen businesses run at 82% net profitability. And that really boils down to efficiencies. And again, taking a step back, that is really, I think, where enterprises can show their value and drive their value, but it has to be driven through that transparency of the books.
That's a really smart point, Jason. The just the concept that, like, look, you could talk about offering higher, commission rates, the 92 to 93% you mentioned there. But the reality is you don't get to keep all of that, right? There is a business being run. It's not just top line revenue. There's a business underneath. And I was actually really surprised when Terry first told me about the lack of, visibility slash transparency down into each individual advisor's business. And I never really thought about that. I knew there was a lack of control on behalf of the enterprise or the OSJ of, in terms of, everything that the advisor does. Part of being part of the organization is, platform access, as you mentioned, and, discounts on certain technology and all that type of stuff. And the OSJ handles some of the pain in the butt parts of the business. But I wasn't aware of that until Terry brought it up, that, yeah, no visibility. It's crazy.
Yeah, and it's been really interesting to see the evolution of the OSJ. And Jason, I know you've dealt with smaller enterprise OSJs and large ones. I mean, there are some OSJs that are larger than many broker dealers, many independent broker dealers, and then some that are small. One thing that I think is almost universally true, at least it historically has been, is that the OSJ is typically much closer to the advisor than the broker dealer itself. And Jason, you might give a history lesson, but the OSJs started really because the independent broker dealers, as they were scaling, wanted to have a variable cost model as opposed to a fixed cost model, and the compliance aspect of it was very expensive, and they were able to offload that essentially into the field, and for that, pay that higher payout that then the OSJ can bring somebody in, take a piece of that rental income, and perform the compliance function. And typically they're closer and geographic, although not always, especially as they've changed. But it's been a fascinating model. And then that has further moved with the movement to being an RIA, where they aren't, it's not commission business, but it's advisory business, and they're again acting as that compliance function.
Yeah, absolutely, Terry. Then it goes down to multi-custodial and having a really broad set of capabilities to serve those local firms that affiliate with them. But you're absolutely right. It started out as a compliance arm and leveraging Series 24 OSJs in the field to serve the masses as broker dealers were scaling. And then it really, ultimately, for those firms, it was a revenue stream to do that compliance work. There was an opportunity to build a sense of community that many large firms had a challenge doing. If you're 5,000 or 10,000 or 15,000 advisors at a broker dealer, can you really build a sense of community with 200 or 300 individual advisors? And many of the enterprises have done that phenomenally well. And then you start looking at the transparency aspect of what we just talked about, looking at advisors' business. Outside of building the sense of community and doing the compliance function, now you're building out services, and firms are building out services to really drive value into those businesses. I don't like the terminology provide value or create value. Value is in the eye of the beholder, but it's really driving value down at that local level that larger organizations, broker dealers have a challenge doing in some cases. But Mike, it goes back to your comment earlier where you're talking about stickiness and within those books of businesses to that enterprise. That's huge if you can truly help them lower their cost to serve, drive growth, drive net new asset growth in their business. That's where an enterprise, that's I think where I'm seeing the evolution. I know I'm seeing the evolution of those enterprises go.
It's interesting. Terry always mentions, we talk about a lot of different reasons why an advisor might leave an organization, but it almost always boils down to money, right? I mean, yes, it can oftentimes be uh, part of the reason is, it's you're too much friction to get things through compliance or whatever within an organization. But it really this is a business, right? Somebody's going to leave if they can get a better deal for themselves and their business. And if you can show them how to make more money, be more profitable, right? Show them how to grow their business more effectively, you're likely to keep that advisor under your roof longer. If we kind of extend that tenant thing. One other thing that I want to make sure we get in here as we're talking about challenges that are also opportunities is, continuity risk is significant. And we've been talking about that a lot lately, just because COVID-19 obviously makes people, nervous, right? Especially the average age of an advisor being around 60 now. So one would assume many of these OSJs have advisors in their organizations that are over 60, and some of them significantly over 60. So how many of the OSJs that you're talking to, Jason, are concerned with continuity risk that, if an advisor passes away, that the business just might vaporize?
Yeah. Oh, this is a great topic to talk about, Mike. I think if you go back last year in 2019, it really wasn't a huge point of contention or a point of discussion with large firms. And you go back in my history of 3, 4, 5 years, it was a topic that was brought up every once in a while in the event something happened to an advisor that was part of their organization. Fast forward to March of this year, we really I started seeing a huge uptick in conversation around continuity. And it was really focused around a pandemic that we were having and how a pandemic can affect many advisors. And if you look at it, historically within these organizations, maybe once or twice a year, you really had a continuity issue where someone became disabled, sick, death, worst case scenario. And an OSJ or an enterprise had to step in and truly help advisors out. As we came into 2020, we came into a situation where if you were a firm that had 100 advisors or 500 advisors or 50 advisors, it really didn't matter. Every single business was at risk in some form or fashion, whether it was staff being diagnosed with COVID-19, being out of the office, or the advisor tracking COVID-19 and being out of the office for a month or 2 months. We actually saw that with a couple firms that I work with. We had instances where we had advisors that unfortunately were away from the office for a couple of months, and all good things ended well for the situations. But I don't think we've ever seen a situation to where you had 100% of the business at risk, if you thought about it from a worst case scenario standpoint. So it's been a huge topic of conversation today as I go forward. Really, number one, thinking about continuity, whether that's the direct advisors that our firm works with or it's the enterprise OSJs that our firm works with. It's a topic of every single conversation we have. How do we secure it? How do we document? How do we plan for it? How do we help advisors in the event that there's a death? How do we help pay for it? That's a big part of the planning right now for large firms because it's the biggest risk they face today outside of potentially attrition risk due to advisors finding succession outside of their organizations.
And Jason, does obviously it is top of mind for all the reasons we know, but historically, it was continuity not a focus because succession. It was really around succession, and that's thinking about some kind of finality event where I'm selling or transitioning my business to somebody. There's a financial arrangement in it, and I'm not necessarily thinking about the fact that I could have ended up in a situation where I can't not only get to the office because I'm overseas and got stuck overseas, or I got COVID and I'm in the hospital and have no access to that, and that all those clients are still there needing to be served and they're not able to be served. Is that kind of the reason? And how do you think about continuity, either separate or as part of succession? Because we know that I shouldn't say nobody, 30% of advisors have dealt in some way, shape, or form with succession, and 70% haven't. And that number hasn't changed for at least a decade. But continuity is something that is maybe an easier step because it's not forever.
Uh, Absolutely, Terry. I'm a California resident, and California has been faced with some natural disasters, if you want to call them that, with the fires that we've had over the past few years. And I've had direct clients, being at my prior firm. That was a natural disaster of Northern California fires, offices being shut down, firms can't operate or they're operating remotely because of that. And so I think there's really two parts of it. It's continuity for your traditional business plan continuity. Broker dealers, OSJ enterprises, individual firms, they've mostly solved for that by all means in the event of a natural disaster. The other part of this is now you truly have continuity for death and disability. It's always been a factor of focus. The urgency hasn't been there, Terry. It's really, hey, we'll get around to it when we're going to get around to it. Now you've seen the sense of urgency going, wow, there's other things that really can affect our business. And if we can't get into the office, how do we continue to operate that business? And if I'm an enterprise, how do I continue to support an advisor who might be a sole practitioner that has two or three or four staff members, that is doesn't have transparency to their staff on their payroll services and everything that it takes to run that business? If you think about rent, office technology, everything from a day-to-day standpoint, the continuity of that is really, that's where the kind of top of mind's been for everybody. So, before, if you were up in Northern California, Napa, many advisors that I speak to up there, a couple of my clients that are actually up there, plan for the disruptions in the event of wildfires. I walked into a Costco. I'm a Costco avid Costco goer throughout the country. Whenever I travel, I pop into them. I was just up recently in Northern California, and you go into a Costco in Northern California, and right when you walk in the front door, it's all generators, gas generators, anything portable in the event of a natural disaster. It's interesting to see that, but you've got this global pandemic that has happened to us, to the whole entire world. Advisors are looking at it a completely different way, and they're really really concerned about what happens if. It's not just supporting them; it's supporting their staff members, but it's also the clients, the hundreds of clients that they serve. And how do you truly have continuity and create continuity for that business to still run like a top when you're not there?
And Jason, and Mike, sorry, but this is
Oh, go
just
ahead.
fascinating to me because, and I think that you have been part of some of these conversations with advisors that are in the process of selling their business or finding a successor for their business. I have talked to multitudes of people who have said specifically that they will take a lower price in many cases to find the right fit for their clients, number one, and for their staff, number two, right? And it's not about them. And I know that this is true because I've seen it, and they are so focused on their clients and their employees if they have employees. And they still and then they leave up to chance the fact that God forbid some death or disability. Because if they don't have a plan, continuity and or anything in writing with a buy-sell agreement or a formal succession planning agreement, it is going to be completely a fire sale and I don't know what the right term is without having to be bleeped out. You know what show? Because it immediately is like it's like a crazy fire drill, trying to get that business ready to be sold. It is leaking oil, in every out of everywhere, and inevitably they get a lot less for what they would, and it's not necessarily the perfect fit because they weren't part of finding that perfect fit.
That's really interesting too, because as you were alluding to, Jason, there's a concentration risk at play as well, because many OSJs, I assume, I know not all, but many of them are regional, right? So if you are an OSJ and you're in Northern California, where there was some severe wildfires, or down in LA, where there were some last year as well. And all of a sudden that wildfire happens and it wipes out some of the businesses that are there. And it's a lot of your businesses. Or if you're in a part of the country where COVID-19 takes hold and really threatens the lives of some of your top producing advisors in that OSJ, it becomes very problematic. So concentration risk, it's not just that what if one of them passes away, it's what if all of a sudden disruption happens en masse, right?
Yeah, absolutely. And the solve for that is the enterprise creating the solution for the advisors that choose to affiliate with them. It's a big part of the body of work that I'm doing today with clients and having conversations with prospects around that, is to support those advisors in the event that happens. Terry, going back to your point around succession and selling the business, 99 out of 100 times it goes like this: who's going to take care of my clients? Who's going to take care of my staff? And the byproduct of that is we'll find the right number to sell the business for. It very rarely is, and there might be some laughs around this, but it very rarely is, let's sell it for as much money as we can, and we're not going to worry about the other part of that. And then it ultimately goes down to the advisor, if they're still around and it's a true formal succession, or a succession in the event of a continuity emergency, is advisors have built relationships for 20 or 30 years with these clients, with their clients. And these are also not just only clients, but they become best friends. And it's their integrity, it's their place in the community. If they sold it to somebody that was, or if they were really focused on the highest price and not looking at who's going to take care of their clients, that is always a big concern. And ironically, it was probably about 2 months ago, I had a conversation with an individual about this, and we were planning for continuity completely around the COVID-19 pandemic. And when we were talking about this, he was roughly about 3 to 5 years out and said, I want to get as much money as possible for the business. This gentleman has been in business for 35 years. Started having a conversation. I said, great, we can find the most money for you, but it might not be the best fit. And we ran down those scenarios. And I'd tell you, it was probably a couple hours later when we got off the phone, he said, the money's not important. Let's focus on the clients and let's focus on my staff, and the money will come. So yeah, there's tremendous challenges out there for many people, as you say, Terry.
And Jason, as you talk to your clients, right, the RIA slash OSJ or OSJ slash RIA, I know that you have worked with us and have used our services. How, how are you positioning the problem, which we've touched on, but then B, the solution, whether it's Truelytics or another solution, on how to not only retain assets, do it in the best way possible for the advisor, for their clients, for their staff, and for the OSJ or enterprise?
Yeah, there's a multitude of items, Terry. It really is, I think, a couple fold here. It's building out services within the organization that, number one, drive solutions into practices that advisors and firms may have. And then second, it's solutioning for the succession needs. I think, well, I'll start on the kind of the driving the value into the business models. I'd worked with so many for so many years, and concepts would come up and where they would say, hey, let's build out this model because our advisors want it. And really, what would end up happening is firms would build it and think that advisors would adopt, adapt, or come or are willing to pay for it, and they weren't. And that was going back to our early conversation, is the lack of transparency of understanding people's businesses. What I love about the Truelytics platform is it gives you that transparency, as I said earlier, really to help identify what are the common challenges that the segment of a $250,000 advisor to a $500,000 advisor is having. What are the commonalities of a $1 million plus firm or $100 million of AUM firm having? And listen, not everybody's interested in growth. I wholeheartedly agree with that. This is a lifestyle business, especially on the independent side. I've been in many offices where you walk in and it's shorts and t-shirt and flip-flops. That's like my office today. I think that's like probably most of everybody's offices just during during the lockdowns. But it's a lifestyle business, so not everybody's about growth. And what I've always talked to enterprises that I worked with is growth is important no matter what life stage an advisor's business is in, whether they want to truly grow. If they just want to maintain lifestyles, that's you have to have growth. You have to have net new asset growth in a business. So there is going to be some driver of functionality of marketing, technology services that are continue to attract new clients or new money from your existing clients in your business. And then ultimately, if you're looking from a succession standpoint, and this is again a lifestyle practice, and think about a plane coming down for landing, you see businesses that are $500,000 one year and then 400 the next year, 300 the next year, and that's great too. That's definitely personal. It's very personal to the advisor if they want to just kind of take that glide path down and run the business out, and they're not looking to sell the business at the end of the day. Ultimately, they've monetized it for many years. Sorry about that. They've monetized it for many years, and they've created the income out of the business. But if you're looking to sell at some point in time, you're going to want to have a business that's showing growth within it. So I think number one, the enterprise itself is building out services to help drive that growth for advisors, and it really boils down to net new assets. The second part of that was really looking at advisors from a continuity standpoint of selling their businesses. I have seen a trend. This happen over the past, I would call it 9 to 12 months, and it's probably been a little bit more accelerated now. The sale market or advisors doing the traditional sale of a business really slowed down over the past 4 or 5 years. I have my thoughts around it. I really think it was driven off of, number one, the market's going up. Not a lot of volatility in the markets. We had some volatility in 19, and then we had a tremendous amount of volatility at the beginning of 2020 here. But markets are going up, accounts are going up. That means revenue is going up, and quite honestly, many of these lifestyle practices probably are working the same, if not a little bit less than they have been working. Now we hit this prior to this pandemic, and especially now in this pandemic, advisors that are probably coming towards the end of their life cycles are looking at what is going to happen next. Are we going to sell this business? Can we sell part of this business? I don't know if I can stomach a 30% drop. Granted, we had a 30% drop and it bounced back. I don't think any of us saw that coming. And I think all of us agree that we're probably going to see a lot more volatility over the next couple of years. And listen, advisors are working harder than they ever have before. Firms are busier than they've ever been before, just to retain clients and calm down anxious clients. I'm an anxious client about these markets. So the real solve, there's so much opportunity for large organizations that serve a multitude of advisors, from 20 advisors to 500, 600 advisors, to start solving for this true succession arm. And then you start thinking about okay, do you want to retain that business and create a marketplace to sell within your organization? That's huge. I've seen over the past 9 months, a little over 9 months, with people that I've worked with or currently are working with, lost advisors that found succession outside of that enterprise organization. And the lights go on when they call the advisor up and say, "Hey, Mrs. Advisor, why are you leaving our organization?" It's because they haven't created that marketplace for them to sell that business within their organization. So they've been focused on driving business, driving the value of the services that they bring down to the organizations. They've been focused on compliance and Reg BI and all the other challenges that industry throws at us. There's that one big one out there, that succession challenge. I think that's going to be massively accelerated over the next 5 years, to where advisors are going to look to sell the business, due to really not wanting to stomach potential volatility over the next 0 to 5 years.
Yeah, you know what? It's funny because you talked about valuation, right? And if you think about an individual book of business, sole proprietor, sub 100 million of AUM, sub $1 million of revenue, really it isn't a sale. They're doing a succession plan, and not that there's not compensation, obviously, but typically the multiple is as a rule of thumb, and I hate using that, is, it's X times of non-recurring revenue and more than X times recurring revenue, right? But typically it's in the, right around 2 range for that person. And, so if you're doing $500,000 a year, maybe in a stretch you'll get $1 million and then it's on some sort of structure that's going to be paid out over a period of years. It's rare that would all be paid up front and you walk into the sunset. And they do the math on it and say, well, if I just worked another year and a half, I'd earn that same amount of money, and I really don't have to work that hard. So I'm just going to keep kicking the can down the road. And I think that's happened, right? But as you think about valuation and as the businesses have changed, if you looked at a OSJ kind of setup that has an RIA, that has rental income, and I'm just going to use real easy math. They have 50 advisors and $5 billion of AUM, right? And if you were to look at a similar RIA, a pure RIA, not rental income, so they're employees, they have 50 people that are client services, et cetera, those businesses are going to be valued very, very differently by a factor of, multiples, like 10x in some cases. How can you help? And not everybody wants to do that, but how can you help with kind of what you said before, and I think Truelytics has a solution. If we just want to find the right person or firm to be a success or acquire that business, we can do it within the four walls of the enterprise, and or potentially the enterprise, goes in and they have their own book of business in many cases where they buy it and take over those accounts.
Yeah, Terry, really, I mean, you hit the nail on the head there. Where I'm seeing the trend in the body of work that I've been doing with firms in the enterprise space, really, it's threefold. I'm really focused on two areas that ViewPointe brings value into organizations, and that's really the organic growth and mitigation of attrition. And I'll come back to those two. The other one is the inorganic growth, and many of them do it very well. It's the recruiting side of it. We've helped out a handful of firms on really understanding and creating their value proposition, what advisors are truly looking at. You can't, for so many firms, you can't get into a match game of payout. It ultimately ends at zero to where there's no revenue to be made there. But it's truly growing that business from an inorganic standpoint. They do very well. They grow, they recruit advisors. Where our focus and our value really has been in the organic side, helping existing advisors grow their businesses, and then the ultimate mitigation of attrition. Kind of one solves the other. The organic growth side is huge. It doesn't cost a lot from an infrastructure standpoint to help drive organic growth at a local firm level for advisors. There's a handful of things that we're focused on there, and a lot of that's out of the transparency that we talked about earlier of having the right tools. I think Truelytics is a phenomenal tool for that. It takes some sweat equity to get it adopted, but once adopted, the value out of it's enormous. And then ultimately the mitigation of risk of attrition, and that just boils down to, listen, if you're not driving organic growth solutions for firms, you probably have attrition risk to where they're going to look at you and look at the firm that supports them and say, hey, we're going to go find another solution. And then you have the ultimate attrition risk of death or disability, and or this succession standpoint, creating that marketplace. I mean, those are really the big risks for large enterprise organizations from a sustainability standpoint. Now, whether they, as a firm, as an enterprise, will want to buy that business, terrific. I think that ultimately needs to be an option. Many of them don't want to be in the day-to-day running portfolios, running end clients, having that responsibility. But I've seen firms that we're currently working with that are actually creating that marketplace and really focused on taking their segment of advisors, whether it's 200, 300 advisors, and creating that marketplace within. So if Mike wants to sell his business, I, as that enterprise owner, am creating that marketplace within my 200 to 300 advisors to find a solution. And even potentially from a recruit standpoint, if I'm potentially bringing in a recruit that is looking to acquire, I'm creating that marketplace. So there's a huge opportunity there. If they don't want to be in the end client management business and own the book of business, they can definitely. It's a focus of retention within their own organization.
Yeah, no, I'm not sorry, trying to suggest that people have to do that or that's the best thing. But it certainly is a trend in the industry. There are several very, very significant broker dealers that are getting into that and really offering a suite of ways to affiliate. Because quite frankly, and I've said this so many times on this show and in other forums, that we are seeing a movement back to a employee model, that all of the people that went independent for all of the right reasons, higher compensation, more freedom, more product, blah blah blah, are now sitting there saying, okay, I'm a couple years away from riding off into the sunset, and I really don't have a retirement plan. There's not a pension plan with my own business, and what's the best way to do it? And in many cases, they're affiliating with, in some cases, the same broker dealer, just in a different way to affiliate.
Yeah. Yeah, that's a trend that you see happening in the industry is broker dealers now creating new ways to affiliate, whether it's a W-2, a hybrid W-2 type of model. And I'm seeing it in the enterprise space too. It's something that firms have to consider. How do they solve for that? Terry, you and I were talking a couple of weeks ago about a real life situation that I'm dealing with, and there's so many phenomenal financial advisors. There are a handful that are phenomenal business owners, and I don't want to take that or make that sound come off the wrong way. Being a business owner is a huge challenge, and truly running a business, HR, everything that goes behind the scenes, and then also you're an asset gatherer or potentially even an asset manager. There's a lot of stuff going on there, and as you said, really the out for an advisor today is to sell their business. That's the only way to really ultimately get out of the business management, the business day-to-day aspect of running a business. And so firms are gotten really smart about it and saying, and looking at building out new affiliation models to say, hey, we'll get you out of the business management business, the HR business, still do what you love doing, and come and be a W-2 or come and be a hybrid W-2, or we'll take on everything for you. I think I see that being a tremendous trend for people. Many times this happened last year with a client that I was working with that ultimately sold the business because that was the way out. And you get in this business, you love doing what you do, you're grinding at it, 30 years ago. As you work through it, you start coming to the end and you're really dealing with all the business challenges, especially what's happening today. Office space, do we downgrade our office space? We have 3,000 square feet, we're not even using it. You start thinking about that and they sell the business. So firms are really starting to adapt and think about ways to create these new affiliation models to solve for that. So when the advisor comes to their end of their time in this business, it's not on a downward trajectory. They can actually step into a new model and go do what they love doing. The reason why they got in the business is to be with clients, to meet prospects, to close new business, not to run the business at the end of the day. So it's a huge, huge trend for me, something that we're talking about on a regular basis.
Yeah, it's interesting that you say that. I mean, I always make the comment that most financial advisors that have built a great big book of business today that you see, they got their start in the industry when they were called stockbrokers, or in some cases, insurance salesmen, basically. And over time, they've evolved into what we call financial advisors today. But at the root of it, they were. I say just it, not to mean negatively, but they were sales guys, right? They went out there and they earned their commission, right? They were never getting into the business thinking I want to run a business. And so when the completely appropriate observation that I've heard just from you, Jason, and from so many people in this industry is that most financial advisors are not particularly good business people. When you think about somebody who starts a business, grows a business, and that business can run itself, whether the owner is there or not there, right? They're just not. They never thought of it as a business as they started to grow it. One interesting thing I'd love to get your take on this, and I started thinking about this as both of you were talking there. Terry and I were on the Skyview Partners podcast a week or two ago, And one of the trends they're seeing is an increase in partial sales of the business, right? That an advisor will sell, 20%, 30% of his or her business, maybe to a junior advisor, maybe to an outside advisor who's looking to take over a business. And so they'll bring that advisor in-house through a partial sale. And over time, that advisor will get to know the business, will acquire more, and then the advisor who is doing the selling can kind of walk off into the sunset when he or she is good and ready. Is that something that's possible in the OSJ business model? So, and pardon my ignorance if I don't know, but if I was an OSJ, I might be thinking to myself, like, I'm going to go find my top producers. It's probably an 80-20 model, right? 20% of their advisors make up 80% of their revenue. And I'm going to offer to buy 20% of all their businesses or 10% or whatever, just to get a stake in there so that I can own part of that business. Is that something that's possible, Jason?
You are seeing, yes, it is possible, Mike. You see that in a multitude of factors and in ways that's being done by a handful of firms out there that have saw that a couple of years ago and started going down that path. There, I think it'll be. We'll see. And I'm hesitant on how I answer this, but I think you'll see that trend continue with a handful of firms out there that will have that focus. Just number one, the having the capacity, having the resources to go out and do that becomes a challenge for many organizations. It's very heavily capital focused, a ton of risk exposure that a lot of them don't necessarily have today, that may not be comfortable with it. Especially if I'm selling, let's talk through it. If I'm selling 10 or 20% of my business today, you know, are we at all-time highs? I don't know, and I don't think any of us know that, especially with the way the markets are going. And if I'm an enterprise buying into that, am I buying it at a high and we take a 5-year slide? That could be challenging, especially if I don't necessarily control the organic growth of that business. Because then what it boils down to is you have to have net new asset growth. It's like dollar cost averaging into the business.
Yeah.
And if you don't have that net new asset growth, the investment can be very, very risky. So definitely some creative ways firms are looking at it. There's some creative ways that we've looked at it of how do you shift out of this rental income business to an ownership business. Again, I think the easy solve there for enterprises that may think that's not a direction that they want to go is to be a facilitator, because there's not a lot of risk in being a facilitator. There's actually a lot to gain. So if they don't want to acquire, I would bet that there are 15, 20, 25 firms within their model today that are acquirers. And so it's really, I think, at that point now, setting the marketplace, helping the advisor that potentially is looking to partially sell go through that due diligence process, that fact finding process on who a potential buyer might be, the matchmaking process. It's involved. Again, there's not a lot of capital that it's going to take to do that, but it's tremendous from to mitigate attrition risk. Number one, and then truly drive value. You're driving value into a seller's business, and then you're driving value into an acquirer's business. That creates a lot of that stickiness that we talked about earlier.
So as we look to close this out here, maybe we get into crystal ball territory. It's always kind of fun. We've talked a little bit about the trends we've seen, and obviously, if some of these trends maintain, they kind of create the future that we expect to have happen. It kind of I'm a big fan of this quote from Bill Gates that says, we always overestimate the change that'll happen or occur in the next 2 years, but we underestimate the change that'll occur in the next 10 years. And he encourages people to don't let yourself be lulled into inaction. And we've all seen that, right? We all think huge things are going to happen in a couple of years. But when you look at what's happened in 10 years, right? I mean, the iPhone is a great example, right? It came out in 2007. It's 13 years old. We all remember the world before iPhone, but it almost feels like barely, right? It's hard to imagine not having one in your pocket and not having that be the primary way you interact with the world. So as you think about things, Jason, what are you thinking crystal ball wise? Like what do we see happening here in the next 10 years or so for OSJs and the enterprise space?
You know, Mike, the margin compression will happen. that is a trend that's been happening over the past 5 years. You can flip that on its head and say that cost is only an issue in absence of value. There are firms that I work with we've known over the years that aren't the cheapest on the block. It's not about being the cheapest firm on the block or offering the highest payout. It's really what type of tools, services, solutions are you driving into practices. If I looked at the crystal ball, there's a ton of regulatory risks that are out there. There's firms that shifted to a hybrid or an RA model to support the inorganic growth or the recruiting growth. You'll probably see some trends of people deciding to not run RAs anymore and either merge with bigger and better firms, or quite honestly, probably go back to their broker dealer's RA. That wouldn't be uncommon. And that's just, I think, due to some of the regulatory pressure that are out there. And then ultimately, I think in the next 5 to 10 years, it's going to be, you'll see some firms come together. I think you'll see scale matters. But what's probably more important is scope matters more than scale. It's really the infrastructure of those organizations and going back to organic growth and solving those solutions for the advisors that are with your firm and at the firm, not the advisors that aren't at your firm. I think if you can solve the ones that are that organic growth solution, that succession, that continuity solution that's on everybody's minds right now, the inorganic growth will happen because of the value that's at the firm. So, I think you'll probably see a contraction in that enterprise space of the number of firms that are out there, and that'll probably be due to mergers, acquisitions, and then truly just the margin's not there to really compete in that space anymore, because it's not going to be about payout anymore. It's really going to be about services provided, and firms are willing to pay for that. Absolutely, I've seen it time and time again that if you can help an advisor or a business lower their cost to serve their end client and remove a little, if not all, the complexity out of running a business, they're willing to pay for it. I've seen on average in my body of work that I've done over the past 15 years, independent practices typically run on 52 to 55, 56 basis point pre-tax margin. At the end of the day, that's pretty good. There's definitely just some discretionary expenses in there. But if you can take that from 55 to 65 to 70, even 75, and that magical number of 82 that I had mentioned earlier in this podcast, that's a game changer for businesses. And I think that's where, if I had the crystal ball, that's where firms are going to need to go, and the ones that are going to be very successful will be there.
Smart. How about yourself, Terry? What do you see happening over the next decade or so that kind of, you think the world of OSJ and RAs are headed towards?
Well, I agree with Jason on a lot of that. I do think that there is going to be a pretty big movement of advisors who go back to being employees in the last couple years of their, particularly the ones that are solo practitioners. I mean, there have been a lot of folks that have moved and created. And I don't mean real businesses, and I don't want that to be taken as a negative, because this is such a great business to have a lifestyle. But that movement from running a large OSJ that really took advantage of the regulatory compliance issue, getting that rental income and taking a piece off the top and competing for price in a lot of cases, and trying to add value in the way that they think about it, still creates risk. And now the risk is also that their in many cases own broker dealer is a competitor for them, but creating something that is more meaningful. And there are things that you can do where you don't have to own it, using platforms like Truelytics that allows you to solve the problem around continuity and solve the problem around marketplace and matchmaking, and doing it with real data and information. But that is definitely something that's going to happen, because the advisor age is only continuing to go up. We're not bringing enough new blood into the system. So I think that is one. And then the second is that technology is going to continue to change. This has been an industry that, as technologically advanced it is, when you think of fintech, the use of technology by the ultimate end advisor has been probably not as high as you would expect. And ones that do embrace technology and understand it and utilize it the way it was intended are going to be the winners.
I agree on that with that one, Terry. And I think I'm going to build on that with my prediction, which we had Tammy Robbins from Pro Equities on the podcast last week. And, she mentioned that she was getting from advisors basically, something that Jason mentioned, that many advisors are really rethinking paying all that money for an office, and they're learning how to manage client interactions using technology, right? To use, as we do, Zoom and other technologies interact, and they're doing all sorts of things remotely. And I think location is going to matter less for whether it's an OSJ, RIA, or a broker dealer, that you're going to see people and advisors living wherever they want to live, being able to acquire a business that's all the way across the country and have it matter less than it would be in the past. Because if all your clients are willing to interact with you on Zoom, why do you need to be in their backyard, right? So I think it's gonna be really fascinating to see how technology shifts things from that perspective. Well, gents, this has been fantastic. Before we let you go, Jason, I'm sure many advisors, OSJs, enterprises are going to want to chat with you after this because you dropped a whole bunch of awesomeness on the pod. What's the best way for somebody to reach out to you?
And thanks, Mike. Over email is the best way. Jason at ViewPointe, E is in Eric, Sam, S is in Sam, G is in girl.com. Jason at viewpointsg.com is the best way. They can reach out to me over phone too, as well as 858-207-3773.
Awesome. And then, as I can attest, you're easy to connect with on LinkedIn. I connected with you on LinkedIn. So hurry up and connect with Jason Gallagher on LinkedIn as well. Very cool. Well, Terry, we know how to reach you.
Yeah,
Very cool.
absolutely.
Guys, this has been a fantastic conversation. I really appreciate you carving out the time. I know we went a little long here, but anytime we have kind of like one of these conversations where you just feel like the insights are flowing, I like to just kind of just let us ride with it, right?
And this is short compared to like Joe Rogan. I mean, we'd be here another 2 hours and smoking a joint.
I was gonna say he gets weed on his podcast. We're remote. Maybe hopefully this COVID thing,
And you can keep this in because if anybody lasts that long, they get to hear the fun stuff.
there you go. Hey, listen, if you're tired of listening, you just pause and come back later. That's always the way I look at it. That's why I don't mind the long podcast. But I thought this one was particularly good because you guys were just on fire and had some great insights. So I really appreciate you sharing them with us today.
Great.
All right,
And Mike,
guys. Thanks.
Thanks.
thank you.
All right. Thank you very much for listening to this episode of the Modern Financial Advisor podcast. It means a lot that you're here with us, and it means a lot that you made it to this part because this was a long one. But if you've listened to the show before, you know my opinion on long form podcasts because most of them are long. But here's the deal. Our listener numbers are really, really good for a niche-based podcast like this. And it's due in part because the content's really good. And I think you as a listener get it, that you can pause if you're listening to it for 20 minutes and you're like, all right, I want to come back to that. Pause and go do something else. You can listen to it on your computer while you're working on something else, or in your earbuds while you're vacuuming, or in your car if for some reason you're still commuting or whatever, or just out and about doing your jam or walking around, right? So take the podcast with you, enjoy it. Make sure, as I said at the intro portion there, send in your questions and suggestions for the show. Please do follow up with OS Jason there, Jason Gallagher, if you have questions that were specific to the content that he covered, or if you want to talk to him about how he can help you in your business. And of course, hit us up at Truelytics. Reach out at truelytics.com for business type questions if you want to learn a little bit more about the solution. Head on over to RIA Base, of course, as I mentioned at the top of the show. You got to check it out. Really, really cool. Team has been working incredibly hard on that. Came out beautifully. It's going to become a standard benchmarking solution in the industry. I think you'll agree there's very little doubt in that when you look at it, that every RIA firm worth their salt will want to go there, check out their firm, see how they compare to others that are peers. They'll want to make sure they claim their RIA firm so that they can make sure all the information is accurate and all the good stuff. So check it out, riabase.com. Okay, I think that's it for the show. We've gone really long. I'm at minute 1 hour and 4 or something like that now. So I will let you go. As always, make sure you're wearing your mask, washing your hands, keeping your distance. We want you to be here for another episode, right? So stay safe and healthy. And then, of course, my always special request, be nice to each other, okay? We need it. We're going to get through this together. And I'm really glad that I have you here every week for the Modern Financial Advisor podcast. And we will see you next week right here in your earbuds, okay? Have a good one. We'll see ya. Bye.